Goldman Sachs and JP Morgan forecasting $4,000 gold by next year. But assuming that plays out and the gold to silver ratio were to get to 50 to 1, at 50 to 1, which is very conservative, at a $4,000 gold ratio, that puts silver at $80 an ounce. I mean, you're talking a double, easy double. Saving dollars now is the dumbest thing you can possibly do. You're destined to go broke. They're going to destroy the value of the dollar. They are going to inflate the crap out of it. There is no other way, period.
In today's news headlines, silver price continues to look for a bounce. The silver market continues to see a lot of noise, but on Monday, it looks like we are trying to find a floor in the market as we have sold off so drastically. The market has been very bullish until recently, so this pullback is healthy. The silver market has gone back and forth during the trading session here in early Monday trading, but what I would point out is that the market is trying to find its floor. We plunged on Friday, but since then have had a trade deal between the United States and the European Union, which, while firming the US dollar, which is typically negative for silver. The $37.50 level underneath current trading is a major support level that I think will continue to be respected. So I'm definitely going to be watching that. On the other hand, though, we may not even drop that far and we may look to the upside. The upside is, of course, going to be paying close attention to the $40 level that we tried so hard to get to but failed. The $40 level, of course, is a large, round, psychologically significant figure that a lot of people will think of as a good headline. If we can get above the $40 level, then I think you've got a potentially explosive move to the upside. But I don't think that's going to be easy to do. It's not a huge surprise right now to see the market going back and forth because we have rallied so strongly since the bottom in April. Of course, this is typical behavior, especially considering that we are in the middle of the summer and volume could be a bit of an issue at times as well. But either way, I like the idea of buying dips. This is a bullish market. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
No free market. It's just manipulations. The traders suck in the speculators, and then right at the end, they smash the price so that the options expire worthless. The big banks get to keep the premium on that, and then it goes right back up. They rinse, wash, and repeat. But this is a game that's much more difficult to do so. And it kind of reeks like we're getting to the end of this game. We've heard that before, but the level of the spread in the exchange for physical jumping up 250% last week. The no shares available to borrow of SLV, none when there's usually millions. The 7 or 8% lease rate, highest I've ever seen. The T plus 8 weeks, the deliveries. Things are changing, and it's as dumb as a mud wall to continue this game. I think they know that. I've been thinking a lot about the gold to silver ratio, and you know, you got Goldman Sachs and JP Morgan forecasting $4,000 gold by next year. I think that's pretty reasonable, actually, on many levels. But assuming that plays out and the gold to silver ratio were to get to 50 to 1, where it's averaged about 45 to 1 for the last 150 years, at 50 to 1, which is very conservative, at a $4,000 gold ratio, that puts silver at $80 an ounce. I mean, you're talking a double, easy double. And so when I think about where silver could ultimately go, there are so many things that are screaming silver and its value right now. You know, UBS just raised its target to $42 an ounce. That's about an 11% increase. But when you look at all of the things that have been happening, to me, whether it be the increase in the lease rate, the lack of shares available to short or to buy to cover shorts on on SLV, the massive delay from T+1 settlement in London to T+8 weeks in London, the huge deliveries. When you look at the distortions that we find in the silver market, when you look at a simple returning to 50 to 1, even if you went to 70 to 1, where it was just a couple of years ago, that puts silver at basically $60 an ounce. That's a solid, 50% gain almost. So you're talking about, I think, the value of a generation. And it seems that things are changing. The way that the market is moving. We're not seeing these massive sell-offs. We're seeing consolidation, choppiness, volatility, but the strength is something that is very different than what we've witnessed before. I'm very, very, very hopeful for what the rest of the year brings for the price of silver. I find it interesting that the LBMA came out the other day and warned of counterfeited metal, which they said distorts prices by creating artificial supply. And you think about that for a second and think this is the institution that's trading billions in unallocated bullion contracts unbacked, selling claims on gold and silver you can't deliver. Doesn't that kind of sound like you're creating artificial supply, counterfeiting in a digital form? I don't know. I'm just throw that out there. I laughed when I read that. But again, UBS is saying 38 to 42 through September 2025. They're talking just in a month through June 2026. So they're basically saying we're right there. By the way, for the people who we're recording this on Monday, the options expire today. So I expect today to be volatile, just like Friday was and Thursday. But I expect it to shoot right back up tomorrow. We'll see if I'm right when the next contract hits the board.
Fidelity says $4,000 gold possible as Fed cuts, dollar drops. Gold could hit $4,000 an ounce by the end of next year as the Federal Reserve cuts rates to cushion the U.S. economy. The dollar drops and central banks keep adding holdings, according to Fidelity International. Multi-asset fund manager Ian Sampson said the firm remained bullish on the precious metal, with some cross-asset portfolios recently increasing holdings as prices eased from an all-time high above $3,500 an ounce in April. The rationale for that was that we saw a clearer path to a more dovish Federal Reserve, Sampson said in an interview, adding that some funds had as much as doubled their 5% allocation over the past year. Also, August is often slightly weaker for markets, so more diversification makes sense, he said. Gold is up by more than a quarter this year as uncertainty around President Donald Trump's aggressive attempts to reshape global trade, conflicts in the Middle East and Ukraine, and central bank accumulation buttressed gains. Still, the metal has traded within a tight range over the past few months, with demand for havens cooling a little as some progress in U.S. trade talks eased fears about worst-case scenarios for the global economy. Fidelity's bullish outlook for gold is similar to that from Goldman Sachs Group Inc., which has made the case in recent quarters for an eventual rally to as much as $4,000 an ounce. Still, others are cautious, including Citigroup Inc., which forecasts weaker prices. Spot bullion was last near $3,315. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
This is my thesis right now. I believe they are going to intentionally destroy the dollar. They're going to destroy the dollar to support the system. I think what they're doing with the stablecoin legislation is they are trying to move the majority of debt issuance to the short end of the curve through stablecoin issue, because you are seeing the governments that used to support our debt are no longer doing so, right? You have now the Cayman Islands and the United Kingdom and Ireland. It's a joke. and they understand that the amount of debt, we have to come up with $28 trillion in debt in 3 years when we only take in $15 trillion in tax revenue. We're not there. They understand that. And we're seeing less and less and less buying of our treasuries. So instead, they passed the stablecoin law where all of these stablecoins will be backed by US dollars in order to have demand for a treasury market that is losing demand. So you put that all on the short end of the curve, right? Where I think they're going to do it, and kind of blur the significance of the long end, which I'll get to in a moment. But I think that's first and foremost what they're trying to do. Remember when Janet Yellen did that? That was good for gold. That was good for stocks. It was inflationary. And I think that's what they're going to try to do. At the same time, they reshore all the gold and they're going to let it go higher and higher and higher and higher. Not very easy for the public to discern. There'll be volatility, there'll be consolidation, but it will keep going higher until people feel it's gotten too high. And then they'll probably come in and revalue it to a level much higher. And they're going to peg it to the Treasury. Why would they do that? Why would they peg gold to the back end of the Treasury market? The short end, the front end, will be backed by these stable coins, which they will pump out by the gazillions because now they have this synthetic demand, not a organic demand like we used to have when we were revered and we ran a surplus and we didn't instigate wars. The Fed creates the money, takes the gold, and gives the Treasury money free and clear. Every $4,000 increase is $1 trillion free and clear to the TGA account. The Fed doesn't have control of that gold. They have control of the fiat. They're owed the money value of that gold, not the gold itself. Anyways, if they do that and peg it to the long end of the bond market, she said 50 years first, shorter durations, maybe 30 and 20, later, maybe 10. But why would you do that? Because now you can have zero borrowing costs. You can put a zero coupon on that. The gold redemption at the end is the borrowing, is the interest rate, is the inflation gauge. The more foolish we are in monetary policy, the higher the price of gold goes. To be able to get that at redemption would allow for long end low borrowing costs, almost down to nothing, which would then enable us to slowly reshore our manufacturing at very low borrowing costs, and then to grow our way out of this problem eventually. The only way you get rid of inflation and where we are right now is to produce our way out of it. And we're a long ways away from that because in order to facilitate the amount of debt that we owe, pay it off, just the $28 trillion in maturing Treasury debt by 2028 with $15 trillion in revenue, we're halfway there. And that doesn't take into account the $3 trillion a year in deficit spending. So you're 25% of the way there. So you have to inflate. They're going to destroy the dollar. They're going to inflate the crap out of it. They're going to use the stablecoin legislation to front load debt issuance into the front end of the market, and then they will let gold go to the heavens. I believe this. Truly, I do. And they will peg it to the long end of the bond market to have zero borrowing costs to reshore manufacturing, to sell Treasury debt, bonds at a much longer duration at a zero borrowing costs redeemable in gold. I think they're going to do this. I truly do. And I guess we'll see. But I think to save in dollars now is the dumbest thing you can possibly do. You're destined to go broke. They're going to destroy the value of the dollar. They are going to inflate the crap out of it. There is no other way, period. So that is my thesis right now. And I'm very, very convinced.
What do you think of Schectman's take? Do you agree with him? Is the big reset a reality, or is it all just bollocks? Post in the comments section down below your honest opinion and share with the stackers your gold and silver price prediction. Now, check this video right here because it's a perfect fit for you, and I'll see you on the other side.